The financial service, which is also part of asymmetric information. So when we talk about financial services, we're talking about the financial institutions like the banks, insurance companies. Financial institutions often have more information about their products they sell, about the products they sell than their customers. For example, following the financial crisis that developed from 2008 onward, it became clear that a wide range of financial institutions and their employees had mistreated their customers. In the US, some banks' employees were incentivized in the years leading up to 2008 to sell mortgages in low-income households. The bank employees had enough information to know that these households would not be able to repay those mortgages after the initial discounted rate of interest had ended. Banks were then combining these mortgages and then selling them to other groups as if they were low-risk products. When it became clear in 2008 that these households were defaulting on their debts in large numbers, it led to the largest financial crisis since the 1920s. There was information failure and moral hazard. Financial institutions like banks, they know they have access to more information, they have expertise. Still, they go ahead to sell, to give access to loans, to give mortgages to people that they know fully well that cannot pay back. But they are doing it because whatever happens, it will not affect them. It will still be on the shoulder of those who took the loan. So like mortgage, when you give a mortgage to an individual that cannot pay back, as soon as the interest paid, or as soon as the discount amount is paid, interest is charged, then you find out that the individual cannot pay back. The amount he or she has paid is with the bank. Then you let him go. You kick him out of the house. Then you sell it out to someone else. So the amount of money he or she has paid is with you. The individual is unable to pay. The individual has defaulted. He doesn't have any other choice than to leave, vacate the premises, or vacate the property. So banks, they know this, but they still go ahead to give out the loan because they know that it's a moral hazard. Why is it a moral hazard? It's a moral hazard because whatever decision they make, they are being protected from the consequence. So that individual that bought the house that cannot pay back, government will ask him, you can't take the bank to the court because the bank gave you a loan, the bank gave you a house, knowing fully that you will be able to pay. And you did not reject it.
You made an agreement.
You made an agreement. So you're at fault here. But in real life, in real sense, the bank knows that those people will not be able to pay back. But they need that initial deposit from them. And as soon as they defaulted, they kick them out of the property. So there's asymmetric information and moral hazard. There's asymmetric information because the banks, the financial institutions, they have more information than those individuals who are saying yes to that mortgage. That's if, as a financial institution, you are supposed to advise them and understand their source of income before giving them that loan, that mortgage. But you go ahead to give them because it's a moral hazard. Do you understand? Yes. So moral hazard occurs when an economic agent like a bank or banker makes a decision in their own best interest, knowing that there are potential negative risks and that if problems result, the cost will be partly paid by the economic agents. So the bank employee who sold mortgages to risky customers knew that these were high-risk loans, but they were paid on how many mortgages they sold. So the bank make it compulsory for bankers to sell those mortgages because they get commission from it. So they continue to sell different mortgages because of commission that the bankers will get, irrespective of you having the financial capability to pay back or not. Just sell to them. Let them make initial deposit. That initial deposit is enough for us. So when they default, we kick them out. Do you understand?
Yes.
So, equally, senior bankers participated in risky behaviors, assuming that if the bank failed, the state would rescue it. They would keep the pay bonuses. So, the point about moral hazard does not only end with loans alone. Banks are seen as too big to fail because banks, they have large numbers of people that they employ. They use more people. So as a result of that, government would not want them to fail, because if they do fail, if bank collapse, workers will be laid off, unemployment would increase. As a result of that, government will bail them out. Government doesn't want unemployment to increase. Do you understand? So the point about the banks is that banks, they know that their customers or potential customers do not have the financial capability to pay back, but they will still go ahead to give the loan, because they know that whatever happens, the economic agent, the individual, will still be paying part of the consequence. Is it clear? Any question about the financial institution?